So this presentation is going to be on interest rates and how changes in the interest rates, the base rate, are likely to affect business. The body that sets the central interest rate in the UK is the Monetary Policy Committee of the Bank of England. So at the time that this video was made, the base rate was 0.1%. Now that means that if banks wish to deposit their funds with the Bank of England, that's how much interest they would be getting on that money. If we look at the examples, there's 4 examples there of interest rates that are being charged at this particular time. If you wanted to borrow money via a personal loan from Barclays, you would be charged 5.5%. Now that isn't that close to the 0.1% base rate, but it is substantially above it. The next 2 examples are savings rates at Barclays, a lot closer to that 0.1%. You can see that with the flexible cash ISA, you'd be receiving 1.2%, and with a 1-year bond, you'd be receiving 0.7%. Now, normally, savings rates are below the base rate for the obvious reason that if banks are only going to get 0.1% when they deposit money with the Bank of England, they don't want to pay out 1.2% to their depositors. On the other hand, if you were a saver, would you actually want to save money and get 0.01% or whatever? And the answer is probably not. So those 2 savings rates are much closer to that base rate. But not all interest rates are close to the base rate. Have a look at that example on the right hand side. Moneyboat.co.uk, which is a payday loan company. In other words, if you run a bit short of funds and you haven't anywhere else to go to, this is the sort of people that unfortunately people do go to. Have a look at that interest rate, 939.5%, which means pretty much that if, say, you borrowed £100 from them and you didn't repay them for a year, 1 year later you would have to pay back £939.50 in interest, plus the £100 that you borrowed from them. If we take a look at the history of base rates in the UK, the top graph shows 325 years of history. And you can see for a fair watch of that time, over 100 years, base rates were 5%. The interesting stuff is the stuff on the right hand side of that particular graph, where you can see that after 2000 it fell by quite a substantial amount, and the interest rates are the lowest that they have ever been in 320 odd years. The more detailed graph down the bottom, if you can put your attention to that one, shows when that occurred, and you can see that after April 2008 the base rate fell from 5% down to a record low of 0.5%, because at the time the Bank of England was desperate that we should spend money because of the financial crash that was occurring around about that time. If you turn your attention now to the right hand side of that graph, in March 2020, the Bank of England, for the first time ever, cut interest rates twice in 1 month, and they fell from 0.75% to 0.1%, which is a new record low. And they did that because the economy was in shutdown due to coronavirus. If you look at the impact of, say, that cut in interest rates on firms, for the most part, it's going to be good for them. Mortgage payers will have more money in their pocket. Now, if we don't look at the most recent example, but we look at that example back in 2008 when interest rates fell from 5% to 0.5%, that's a 4.5% drop. Well, imagine that you had a loan of £100,000 on your mortgage. That would mean 4.5% of £100,000 is £4,500. So your annual repayments just on the interest would come down by £4,500. That's nearly 400 quid a month. So you're going to be spending a bit more. No, it ain't going to be doing anything like that with that cut from 0.75 to 0.1. But generally speaking, mortgage payers will have more money in their pockets, so they're going to spend more. So most firms are going to be doing better, particularly income elastic firms. Now, a lot of goods are bought on credit, so a lot of people borrow money because they want to buy a car or a decent TV or whatever. Now, again, when the interest rate comes down, the interest rate on repayments of those things also tends to come down. So again, that might make young people particularly more inclined to do that. Of course, not all firms will benefit. There are some firms that sell primarily to older people, Steradent, that sort of thing, or I don't know, Zimmer frames. They would tend to do worse because for older people, the interest that they receive on their savings will be going down, and so they won't be in as strong a position. Now, finally, if we look at the impact on business of this interest rate cut, well, the first point is obvious. If the interest rate has come down, then firms are going to be more willing to borrow money for investment. The second one, slightly more convoluted, firms with a high gearing ratio, firms who have borrowed a lot of their long-term funds, they're going to find themselves in a slightly better position because remember, they're going to be burdened with interest payments, and those interest payments will be falling. So they're going to be feeling slightly more relieved with that interest rate cut. And that's it on interest rates.